Hello, 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 everyone. Welcome, welcome, welcome. We are so glad that you are here to listen to Nate Hare about at the Nest Egg Builder Show, which comes on every week, as you know. So the Nest Egg Builder empowers investors with knowledge to assess risk, conduct proper due diligence, and make strategic investment decisions. And Nate's going to talk a little bit about some things you could do to support that. Let me tell you a little bit about Nate Hare. So, Nate is an executive director at a company called Directed IRA, which is a self-directed IRA company and has, 401ks and several other opportunities for you to have your money secured and safe for your retirement. And he is a 10-year veteran in the self-directed IRA industry, spending most of his career as an executive educator, which he'll do for us today, and public speaker. Nate is a certified IRA service professional, a licensed loan officer, and has extensive experience in real estate, business development, and as an investor, private lender, and self-directed IRA executive, Nate has personally overseen thousands of self-directed IRA investments involving real estate, promissory notes, and more. I bet you have seen a lot more. Nate is an expert on self-direction and has been a contributor to, are you ready? The US News and World Report, Fox Morning News, and has helped educate tens of thousands of individual investors on how to use self-directed IRAs, 401s, and other plans properly. That properly is the most important word. He has been a major contributor to the growth of two self-directed IRA companies, including Directed IRA, the fastest growing self-directed IRA company in the country, named by Inc. 1000 list for the fastest growing companies in the US for 2023, and with over 700 five-star reviews. Good for you. God, that's great. That's amazing. Nate holds a business management and finance degree from the University of Portland and was named one of the top 100 people in finance by Top 100 magazine in 2019. Every week, he discusses a different subject and provides tips. As an expert, he will answer all of our challenges and questions regarding finance and real estate. And so I would like to present to you Nate Hare. We are so excited to have you here. Please take it away.
Well, thank you, Peggy, and I appreciate being with you guys all today. I get to talk about one of my favorite topics within self-direction, which is actually private lending with self-directed IRAs. The reason why I like it so much is that's what I do with my own self-directed IRA. So I like to talk from experience. I love real estate in an IRA. I love those strategies. I love cryptocurrency. I love all of it. But private lending is what I do. It's where I got my start in real estate. Back when I got out of college, I went right into the mortgage business, and that's kind of where I got my taste of real estate. So I've always been good with numbers. I've always been good on the finance side of it. And it was in 2012 when I was recruited by Quest Trust Company out of Texas, was the first time I ever heard of self-directed IRAs. I had an IRA at Northwestern Mutual. It had a bunch of stocks and mutual funds in it. I didn't even pay attention to it. My advisors just told me all you have to do is throw money in it, and that's how you retire. Oh boy, was I wrong about that.
Boy.
But what I did find out at that point, which was a pendulum shift for me, is I did not realize that all the things I was doing outside of my IRA could be done inside of my IRA. And what I mean by that is I owned rental properties. I was giving loans, hard money loans to real estate investors. I was doing all of that outside of an IRA. Had no idea I can do it inside of an IRA, inside of an IRA. So in 2012, I went full-fledged into self-directed IRA education. I've been in the business since 2012, so I'm about 12 years in the business. Now I'm the vice president here at Directed IRA. But a lot of you guys might recognize me from my days at Quest. I was at Quest for 10 years up to 2021. So I'll just jump into it and let me see if I'm sharing my screen here. Can you guys see that? Okay.
Yes.
Okay. And I have more slides than I can share, but if you guys want the entire slide deck, just shoot me an email. I'll have my email address at the end if you want the full slide deck. I have no problem sharing any of this with you. First, of course, our disclaimer as an executive at a self-directed IRA company, I'm not giving tax, legal, or investment advice. We're just going to share a bit of education today. I'll know that you can invest in all sorts of things with an IRA. So I'm not going to spend too much time on this. But I will point out, because a lot of even the advanced investors ask me on a daily basis, Nate, what are most people doing in their self-directed IRAs? What are they investing in? I would say for the vast majority, and this is across the gamut with all self-directed IRA companies, the majority of the assets we hold as a self-directed IRA company are real estate based. They're not ownership of fee simple real estate, but they're real estate based. The largest majority of the investments that we process on a day-to-day basis, I would say through directed IRA, are passive investments into real estate. Whether somebody's taking their IRAs and investing in some syndication, or taking their IRA and investing in some commercial deal or some land vertical integration real estate deal, or lending through a promissory note or even buying existing promissory notes are the most common way people use their self-directed IRAs. And there's a large amount of reasons for that, but I would say the majority of our clients who self-direct are not real estate investors by trade. They're not real estate investors. That's not their career, but they have 9 to 5 jobs. They just like the ability to invest in real estate through their IRA because they find it's either safer, more secure, more predictable, whatever the case may be, but they need a self-directed IRA through a company like Directed IRA to invest in what we call alternative assets. And one of the alternative assets we're going to talk about specifically is promissory notes. So why are promissory notes, at least to me, so much more attractive than just stocks and bonds and mutual funds and even other some other investments? Well, for me, when I'm doing an investment, and we're going to talk about the process here a little bit, when I'm going to make a loan to a real estate investor, and I'm pretty particular on who I loan to. I like to loan to real estate flippers in Texas. A lot of them are in Houston, Texas. There's a reason for that, and I'll get to that. But the thing about it is I get to decide where and who and when my money out of my retirement is deployed. That's where the self and self-direction comes from. It's still a passive investment underneath it all. Somebody else is going to do all the work to find the property that I loan secured by. They're going to do all the work. They're going to hire the contractors. They're going to hire the subcontractors. They're going to find the sell. They're going to find the buyers. My money is just used to buy the property, and maybe some of my money is used to help finance the rehab. But for me, I like that it's passive. I don't deal with toilets, tenants, or ownership headache. My IRAs are just a bank. Now, it gives me good diversification because even if I wasn't a sophisticated note investor, I still see a lot of investors like the ability to hold notes in their retirement account because it gives them diversification from their other retirement assets, whether those are bonds or mutual funds or precious metals, whatever the case may be. Well, one of the biggest things I think with lending specifically is if you think about in real estate investing, right? There's a lot of arguments that people would say, well, I like real estate investing outside of an IRA because I get depreciation and I get cost segregation. I get all these wonderful tax benefits to me as an individual investing outside of an IRA. Well, outside of an IRA, when you lend money, there's no tax benefit to that. Unless you have a large company, a lending company, you don't get tax savings when you're loaning money to an individual with your own personal money because you have to treat your interest income as a person as ordinary income. So there's really no tax shelter for a lender using their own personal funds. But when you're using your, let's say, Roth IRA or traditional IRA or your rollover IRA or your self-directed health savings account or your child's education savings account, these are all tax exempt vehicles that have tax shelter to them that pay no taxes on the interest income. So for me, it's a huge pendulum shift. If I'm going to lend anybody money, it's never going to be my money personally in my bank account. It's always going to be money in my IRA because there's just massive differences in how that income is treated to me. So there's a huge tax saving opportunity with lending out of your tax shelters accounts, and we're going to talk about the different types of accounts you can lend out of. Here's the most beautiful part to me is it's predictable. When I find an investment that I want my IRA, whether it's my Roth or my HSA, to be a lender to a borrower, we negotiate the terms. The terms are put in a promissory note. There's an agreement between me, the IRA's fiduciary, and the borrower. Whether it's they pay 2 points up front, 12%, it's predictable. And I know exactly when payments are supposed to come into my account because it's specified right in the note. And if I do my due diligence and I close properly, not only do I have a note that spells the terms of what my IRA is supposed to earn, but if something happens to my borrower, as long as I close at a title company or an attorney's office, I've got a deed of trust or I've got some sort of security instrument that allows me to have collateral to the property. So it's safe, it's predictable, there's a massive amount of tax savings. And at the end of the day, I'm helping an investor buy an eyesore in the neighborhood, fix it up, turn it pretty, and sell the American dream of homeownership to somebody. So there's a socially conscious aspect to what I'm doing too. Oh, and by the way, private money goes for anywhere between 9 to 14%. If you're loaning to the right people, you can get double-digit returns backed by real estate tax-free inside any of these plans. So when you talk about self-direction, realize there's more than just your traditional and your Roth IRA or even your 401k that can be self-directed. You can self-direct all sorts of plans. You could even self-direct health savings accounts and Coverdell education savings accounts, which are not retirement accounts at all, but they are accounts that are tax exempt trusts, just like the others. You can make contributions to them. Sometimes you get a tax deduction on contributions, sometimes you don't. But either way, all of these accounts, when interest income is realized into these accounts, it's all tax exempt. There's no taxes paid on any of the interest income. Now, what you want to ask yourself is, how do I want to take the distributions out of the plans? And hopefully you want to take the distributions tax-free. So interest income comes in tax exempt. And then when I take money out to use it, it comes out tax-free. So if I look at the accounts that I like to use as far as what I lend money out of, I lend money out of my self-directed Roth IRA. If I was self-employed and I had the opportunity to have a solo 401k, I would 100% be loaning money out of a self-directed Roth solo 401k. But I do actively use a self-directed health savings account. And I have two nieces with two Coverdell education savings accounts that I have set up for them. And those are both accounts that when interest income comes back to the money after it's deployed out of those accounts, I don't have to wait till retirement to use tax-free dollars out of my health savings account or the Coverdells. I can take dollars out of that as soon as a borrower makes payment to the account. I can take a tax-free distribution out of the account to pay for qualified health expenses for me, my spouse, and my dependents, or qualified education expenses for my kids, my grandkids, or my nieces is who I have it set up for. So when you look at these accounts, just realize all of these accounts are tax exempt trusts. These don't pay taxes like you pay taxes as an individual. So if you're going to be a lender or investor, these are the accounts that are going to grow faster and longer down the trough because you don't have to give Uncle Sam any profit. Now, when I partner on loans, and I'm going to skip past this a little bit, but when I partner on loans, I will tell you one of the easiest things why I like lending is in order to bring different plans together on, let's say, the same investment, loans is one of the easiest ones to bring all your plans together. Okay. What I mean by that is, sometimes if you're investing into like a syndication, for example, there might be a syndication that has a $50,000 investment minimum. Usually some of these syndicators, they will not let you partner two accounts together to meet the investment minimum. You can't take your traditional IRA and your HSA and have that as one subscriber unless you have some sort of additional entity in between your retirement accounts and the investment sponsor. But if I want to bring my plans together on one investment and as a loan to a borrower, all I have to do is put my plans on the promissory note. All I have to do is list each plan on the promissory note, whichever plan I want to use, and each of my plans will have an undivided interest on that one promissory note. It's not multiple liens. It's not multiple notes. It's one note, and it's just called a fractionalized note. So one of my first loans that I did out of my IRA, I partnered with 14 other people. I'm not telling you that that's a fun investment, but I will tell you when you're getting into it, you look for other people to leverage. And we had a great deal in Houston, and we needed more money than was just in my account. So we brought together 14 different IRAs, all listed on one promissory note, that all had a different interest in the note based on how much each plan put in. But when the custodian sends the money, they just send one wire to the title company. They just take money from all those plans and send one wire. And then the borrower, when they make payments, they just make one payment back to the custodian. The custodian just splits the payment pro rata amongst the different accounts. So if you think about it that way, if you've got a Roth for yourself, a Roth for your spouse, maybe you have kids that are working and you set up Roth IRAs for them. You've got a health savings account, maybe even got some ESAs for the young kiddos or grandkids. You can literally list all those plans on one promissory note and have all those funds deployed in one note, receiving one payment, and all of them get to share on the tax-free income. But remember, when you use multiple plans, not only do you have some of the income going back to feed your retirement with tax-free dollars, but if you're using an HSA or some ESA funds, you also have some tax-free dollars you can use to pay for healthcare and education. So one of the things that we get a lot of questions on is, so if I'm going to loan money out of my retirement plans or my self-directed plans, who am I allowed to, can I loan money to myself? That's usually one of the questions. When you look at the IRS rules, and I know most people who are familiar with self-directed IRAs understand this, you cannot self-deal your IRA to yourself. The IRS is not really particular about what our retirement account owns as far as what the asset is. You can own anything in a retirement account except life insurance and collectibles. Those are the only two investments that you can't hold in an IRA. But the IRS is very particular about who your IRA transacts with. Since you're the fiduciary to your own IRA, you're the fiduciary to your own HSA, you're the fiduciary to your kids' ESAs, you cannot tell your plans to make loans to you. It's a conflict of interest, right? Is your IRA going to tell you no? You make the decisions for both parties. So they want you to only do investments with what they call non-disqualified people, right? Your IRA can only loan people that are not yourself, your spouse, your kids, your parents, your kid-in-laws or son-in-law or daughter-in-law, and any companies those same family members own or control. So again, the people your IRA cannot loan to, you cannot loan to yourself, can't loan to your spouse, can't loan to your parents, can't loan to your kids or your kids' spouses, and you can't loan to any entities those same people own or control. But you can, which is a little weird, you can loan to brothers, sisters, aunts, uncles, cousins, nieces, nephews. And some people say, well, why are those family members okay, but the family I'm closest with are not okay? Well, it's the reason that you're close to them. And it's really more the reason of when you die, your plans usually pass to the spouse or to the kids. By default, your plans pass to the spouse or lineal down to the kids or your grandkids. So since they're in the line of inheritance, they're considered disqualified people as well. You usually don't pass wealth to the side. You don't leave all your assets to your brother or your sister. Your wife would dig you out of the grave and kill you again if you left everything to your brother. So they're not worried about family to the side in most cases. They're more worried about loaning to yourself or those specific people that I mentioned. So just don't do it. And if you have questions, reach out to me. I'll try to answer any questions. But that's the main thing is you just cannot make loans to what we call disqualified people. Okay. Remember that your benefit from your IRA is to make it grow and then live off the distributions tax free or tax exempt. That's where you get your benefit, but you can't tell your IRA to make a loan to you because you're receiving a personal benefit outside of distributions. So I'm going to skip these, but these are 10 considerations I think about when I'm before I lend to somebody. They're pretty I would say pretty cut and dry. I break my rules every once in a while, depending on who I'm loaning to. But they're just good things to think about before you make a loan or consider making a loan out of one of your self-directed plans. One of the things people always ask, well, Nate, well, what about foreclosure? I always say, well, what about it? I would say I said earlier, one of the reasons that I loan in Texas, and again, I would loan in other states, but I lived in Texas for 9 years. I understand that it's a business friendly state. For me as a lender, my main concern is if I loan to this individual and something happens to that individual, right? My money is secured by the property. What's going to happen after that point? In Texas, I know exactly what I need to do as far as the foreclosure process goes. Okay. I know that if my borrower dies and they don't make a payment, I can send a notice of default. Okay. As soon as they're 5 days late, I can send a notice of default. Once they're 30 days late, or once they're nearly 30 days late, I can send an acceleration of the notice. And if they don't pay and they get no response or no payment back, the state of Texas allows me to start the foreclosure process in as little as 60 days. So for me as a lender, worst case scenario, I do not want the house, but I know that if they stop making payments, my worst case scenario is I take the collateral, which is the house, and I can literally have that house owned in my IRA in as little as 90 days. There's other states, it takes years to foreclose. This is also why I would never loan to somebody on their owner occupied property. I only loan to people on investment property and I loan on in business friendly states. That's just me. It's my money. I decide where to deploy it. Okay. Everybody's a little bit different. But I would say, depending on where you are making a loan to, understand the foreclosure process in that state. You have to understand the foreclosure process in the state your money is secured by, and do not do business in states that you're not familiar with. So get familiar with the state first before you be to loan on a deal out in those states. Um, I will say, I'll just go over this real quick because I know we're probably at 20 minutes already. This is this is like common deal that I'll do. And I partner most of my deals to real estate flippers with my Roth IRA on the note and my HSA on the note. So this is a real basic boilerplate deal, right? An investor needed about $100,000, found this property through some skip tracing. It was a property in Houston that was abandoned. I mean, when he showed me the appraisal, this isn't the actual house. I couldn't find the old appraisal. It was an old email, but the grass was so tall, it covered the house. You could only see the roof. That's how long this house had ever been even looked at. It was in a rough area of town. His conventional bank would not loan him the money. When they saw the appraisal, they're like, we're not even touching that house. The hard money lender he worked with said, "Yeah, we'll loan you money, but it's going to take 2 to 3 weeks." Well, the thing was is that he knew that this person that he talked to, they just now found out they own this property because they inherited it from their grandparent. So he made an offer to buy this for 75,000. He wanted to just act on that quick before this person changed their mind or started shopping. So he came to me with private money and said, "Hey, Nate, this property comps out at about 215. Like, would you be interested in loaning $100,000, 75 to buy it, and I'll need about 25,000 to rehab it. It costs a little more to rehab, but he had some of his own funds in it." And I said, "Sure. Are you okay paying 2% and 12 or 2 points up front and 12%?" He said, "Hell yes." Sorry if I'm cussing. He said, "Yes, because I can't get a loan from my conventional bank. My hard money lender is going to take 2 weeks. I need to buy this property and there's $100,000 of equity in it. So can we get the deal done?" Okay. So we structured the deal as a simple interest note. Okay. I usually do 6 to 18 month loans. Why? Because I want to get paid back. And most of the arrangements are just like this, where this gentleman, all he needed was money to buy the property and hold it for a year, fix it up, either sell it after the year or refinance it to his conventional bank with a conventional loan with a lower rate and then pay me out, which is perfect for me because I get all my interest and principal back and I can redeploy it on his next deal. So this deal was partnered with my Roth and my HSA. So all we had to do was have my attorney draft a promissory note. My Roth IRA put up 75,000, so 75% of the note was owned by my Roth IRA. 25% of the note was owned by my HSA. We closed at the title company. Directed IRA sent $100,000 to the title company. And then from that point on, there was an agreement in the note that he had to pay monthly interest payments. And he was on time all the time, every time, because he had $100,000 of equity that was at risk if he didn't pay. So every time, every month, his check would come in, the interest payment would come in, and directed IRA would just split that check 75-25. Remember the difference between my Roth money and my HSA money. My Roth money, I don't want to touch those earnings until 59 and a half. That's when that becomes completely tax-free for life for me. But my HSA funds, all the interest income going to that, I can take that out tax-free to buy glasses. I can take it out to pay for dental work, right? Vision, prescriptions, acupuncture, holistic medicines, co-pays. I mean, all the things that I would have to pay for that most people pay out of their back pocket when it comes to health expenses that their insurance doesn't cover. I just pay it with tax-free dollars from my interest income from my HSA investments that are invested in other people's deals that are paying interest income where I don't have to deal with toilets and tenants. So if you think about the ability to grow your money in that fashion, where you can dictate the terms, you can decide who you loan to and where you loan to, it's really just about how fast do you want your money to grow? If I just continue to do this and I have the ability to compound my interest at 14%, meaning I get paid in a year and then I redeploy not only my principal back into the streets, but I redeploy my interest that I earned. I don't even have to make another contribution to my account. My $100,000 will turn into $1.4 million through the sweat equity of somebody else and me just deploying my funds secured by real estate and negotiating double-digit returns. And again, I'm not saying it's easy to get double-digit returns, and sometimes you're on the sidelines, but I will tell you, a lot of times I'll clause in the note just to do an optional extension. So if the borrower is paying on time and they want to keep it another year and I don't have another deal, sure, let's just pay me a point and we'll keep the loan going for another year. So it's a very predictable way to grow a retirement account. I like it because I get to work with real estate investors on a daily basis. They're all better real estate investors than I ever was. But I also get to see what my money does. And for me, it's seeing that my money is not only helping a local investor, but it's helping put contractors to work. It's helping put subcontractors to work who are putting money back in our local businesses, who are employing, local employees. I mean, all of that is something that I think you start to learn is something means something to you a little bit when you start investing, and when you can make double digit returns at the same time. I don't know. I just get warm and fuzzies talking about self direction just because I see it and I see the effect that my own investments have. So here's another deal. I don't have time to do it show this one, but this is a shared appreciation deal we did in Fort Worth. It just shows you how creative you can get, and you can even structure certain deals where your IRAs can get a piece of the equity if it makes sense. But I can maybe go over that another time. But I guess I'll take questions at this point, and I hope it was helpful to you guys. Here's my email if you guys ever want to shoot me an email and ask any questions. Just shoot me an email, and there's a special little promo code if you guys ever want to open an account with directed IRA. So
That's great.
that's that,
Thank you
Peggy.
so much, Nate. That's absolutely terrific. I do have a question because I don't know much about this, and that
Yeah.
is about the HSAs.
Oh yeah.
So can you stop sharing your screen so everybody can see you?
Yes. Yep. Yeah.
Thanks.
Actually, can I ask a question really quick? Does that
Absolutely.
scan code, like if we were to scan that, does that go right to you, or do we send you an email to get a deck and
Why don't you
or-
send me an email so I can send you a deck? So
okay,
yeah,
perfect. Okay,
send
thank
me
you.
an email. I'll send you a deck and I'll send you a
Oh, okay,
coupon.
great. Okay. I'm sorry, Peggy.
No, no, that was a question. That's perfect. Oh, and hi, Angel. We're so happy you're here. So, so Nate, the HSAs, I know you could, is there a minimum you have to put in or can put in or a maximum and you can't go above that when you open one? So nobody
So
really talks about HSAs and how they work.
I love the HSA. So there is a maximum, and it depends on, first of all, you have to have a special type of insurance to have an HSA. It's just a high deductible health plan. Just call your health insurance provider and ask if your plan is HSA compatible. That's usually the easiest way to find out. If it's HSA compatible, if it's just you covered on your insurance, it's a single plan, and I believe the contribution maximum is 4,150. So that's the max you can put in.
Per
Now,
year?
per year, right?
Okay,
4,150. If it's you and another person covered on your plan, it's $8,300.
okay.
If you're above the age of 55, you can throw another $1,000 in on top of either of those. Okay, so you can get all the way up to say $9,300 if you are above 55 and it's a family plan. But here's the thing: It's tax deductible. It's free money to just, if you can have an HSA, it's the first plan you should contribute to. Because with a Roth grows great. It's tax free, but I don't get a tax deduction on my contributions. My HSA grows like a Roth, but it also gives me a tax deduction when I make a contribution. So I actually contribute to my HSA before my Roth because it's free money. I throw $4,100 in, I get to write $4,100 off on my tax return. But then I get to invest it and take the money out tax free for retirement. So that's the one that I fund the most. So I know the contributions are a little small, but again, it's the growth is unlimited. And that's the thing. I had somebody buy a discounted note with an HSA, which was a phenomenal investment. They bought a note at a discount. It was I think it was a $70,000 note that they bought for $30,000. So again, there's a lot of different strategies on how you can exponentially grow an HSA. There's no limit on growth. There's only limit on what you add to it as a contribution, and that's 4,100, 4,150, I believe, for a single person, 8,300 for family.
Thank you. I have a few other questions, but Chris has some questions.
Yeah, for someone to qualify that, you have to have like the worst health insurance. It's like the with the highest deductible. If you have any like if you have like a like gold, silver, or, plan from like Blue Cross and Blue Shield, you won't qualify. You got to have them with like the highest deductible.
Yeah,
So
I mean, I guess it's worse. I guess worse is relative, right? Because for me, I don't go to the doctor very often. Like I never hit my deductible. So for
You're a
me,
typical
I'm
male.
yeah, well, I want I want the lowest premium, right? But I guess it's also a trade-off too. I've had somebody, and Chris makes a good point, right? Some people want they want the better insurance, they want the lower deductibles. But I had an investor, a friend that he was older. I mean, he admitted that he goes to the doctor a lot, but he still liked to have the high deductible plan because when he ran the numbers, the compounding interest effect and the way that he aggressively invested his HSA, the earnings of his HSA tax free outweighed what he had to pay additionally out of pocket for the health insurance. So again, it's a math problem. It's like how much do I need this insurance versus how much do I need this tax free vehicle to me? Everybody's going to be different.
Can you take the money out anytime?
Anytime tax-free and penalty-free. Pay for a qualified medical expense. And it's actually pretty cool in how flexible it is. A lot of people get the HSA confused with the FSA. The FSA is the flexible spending account. It's so flexible that they take all the money from you if you don't use it by the end of the year. So that's not flexible at all.
Oh, it's
Yeah,
flexible to them.
yeah, flexible to them, not to the person that has it. But the HSA, this is really the flexible account because you don't have to take money out to pay for each expense. In fact, the HSA rules will allow you to reimburse yourself later in time for expenses you incurred today or in the past, provided you were covered by an HDHP and have the health savings account. So let me just give you a scenario. Let's say you've got a health savings account and you've got the HDHP and you've got it for the next 10 years. I can make 10 years of tax deductible contributions, and I'm obviously going to have some health expenses along the way. But if I have expenses like I got to buy some glasses, I got to get a root canal, I got to go to the dentist, instead of taking the dollars out of my HSA that can no longer be invested and pay it with tax-free dollars that way, I could just leave all the capital in my HSA, let my HSA continue to be compounded on promissory notes to other investors, let it grow because the larger amount I have compounding on itself, the faster it's going to grow. And then meanwhile, when I do have a medical expense, I'll just pay it out of pocket, but I'll save the receipts. And then 10 years later, if I've got $20,000 of receipts, I can take a $20,000 tax-free, penalty-free distribution to pay myself back for everything I paid. But since I'm just paying myself back, I can use it for whatever I want. I've had a client buy a new Cadillac with an HSA distribution. I had a client take his wife to Europe because his wife kept telling you've never taken me to Europe. And so he took a $10,000 tax-free distribution out of his HSA to pay himself back for some expenses he paid in the past, and they went to Europe. So it's really flexible, and you can go out as far as you want. There's no limit on how far you go out. You just have to reimburse yourself for an expense you incurred while you had everything in place.
So you have to show that you actually had the expense to get the money back.
I mean, Do you have to show? Yeah, I mean, you probably should have the receipt in case you don't have to show the IRA custodian. We don't ask you to provide receipts, but if you're ever audited, you want to be able to say to the IRS agent, yes, this is what I paid for.
So
Now,
what is the point of a HSA?
what is the point of it?
Yeah, if you can only put $4,100 a year in and you have to
Mhm.
have really lousy insurance, what's the point of it? Why can't everybody have an HSA, but put $100,000 in it when they really need it later in life because
Well,
they're having CAT scans and
that
MRIs and all those.
if I made the rules, I'd let people throw in $100,000, just like in an IRA, right? You ask your question, why can we only put seven
I
thousand
know.
dollars in a Roth?
Why is that?
Right?
I thought it was supposed to be for our retirement.
Well, I guess what they want you to do is they want you to start these things early. I don't know. I'm not in the boardrooms when they make these rules, but there's limits each year on how much you're allowed to put in. But there are massive benefits to an HSA simply from making the contribution and taking the deduction. I will say they're not taught very well because I would say 50% of the people that I talk to have HSAs, they think it's a savings account. They don't even know they can invest it because their HR department or the benefits department didn't tell them this can be invested as well. So people usually just use it as a savings account. They put money in, they write it off, but they don't do anything with it. Yeah, those HSAs can be invested in mutual funds, cryptocurrency. I mean, they can be invested in anything. And I like to invest mine in promissory notes. So for me, like, what's the benefit to me? It's money that I have that I got tax deductions on. It's money that I invest passively that I get involved with my Roth IRA on the same deals. And it's tax free for me whenever I need it. And if I need an emergency bucket, I can take money out to pay for a qualified expense. Here's one more fun fact on the HSA. Again, this will blow anybody's mind. You can use one time in your life, you can move money from a traditional IRA to fund your HSA. So one time in your life, if you got a traditional IRA, a rollover IRA that's taxable to you anytime you take money out, and you got to pay a penalty if you take it out before 59 and a half. If I've got a family plan HSA and I want to fund it, I can either fund it out of my back pocket if I need the deduction, or I can just take $8,300 from my traditional IRA and move it right over to my HSA. When I move it to my HSA, it's tax free. And if I take the $8,300 out of my HSA for a qualified expense, it's tax free and penalty free. So I just moved it from an account that I'm taxed on and penalized from if I take it out for a medical expense and moved it to an account that I'm not taxed and penalized on. And you can do that one time in your life.
One.
Bro, your voice is so
I don't
sexy.
make the
Like,
rules.
like, bro, how
I
is it
don't
so
make-
smooth like that? Like, how
I
your
don't- I
voice
don't
so
make the
smooth
rules.
like that, bro? How you?
Okay.
Who was that?
I don't know. It's a jokester, apparently.
They're done.
Yeah.
So, Eugene, you have a question.
Hey, so a little background. My better half is starting a women's investment group in Chicago. They had their first meeting a few weeks ago. Very discriminatory, not allowing me to be part of it. Women only. Women attorneys, women CPAs. So she's got her service providers. I did her self-directed IRA presentation so she could do it. And I told her, you need to get somebody that she wants a woman to be part of a group that runs an organization like yours. So my question is, do you have any ladies in your office that she could talk to? Because she won't allow you to do it.
So sorry, your phone's kind of muffled there. So you're
Yeah.
asking me, do we have any ladies in our office that can talk to somebody that wants to set up an account? Was that the question?
It's a women's investment group, real estate.
Oh, women's investor group. Yes.
Real estate investment. So we've got the lady attorney, we've got the lady. So we've got
Uh-huh.
the service providers.
Gotcha.
And I
Yes.
told the self-directed IRAs need to be part of it because a lot of these ladies, they got a lot of retirement money. So, but it can't be a guy.
Yeah, I get it. So yes, we do. So directed IRA, we've gone out and hired some of the most experienced people in the industry. So I've been in the industry for 13 years. My counterpart, Lindsay Mercino, has also been in the industry for 13 years. So she's our executive director of client services. She used to work at Provident. She worked at Bitcoin IRA. She also does some speaking. So if you want me to connect you with her, just shoot me an
Yeah.
email.
Okay, we'll do. Thank you.
Yep.
Yeah, very discriminatory. Will not allow me to be a part of it.
Sorry
Oh,
about
okay.
that.
I gotcha. Sorry about that.
Oh,
Well, if it
well,
makes you feel better, I don't think I can be a part of it either. So.
Uh,
like that. Okay. Yeah, we
Yeah.
don't know why the government limits us to, if they really want us to have a retirement, I don't know, the government.
Yeah.
It's like they don't really want you to have enough to retire. And then I just met this lady who had a Roth IRA and spent all of that on educating her children because she did set up a separate education fund and
Hmm.
contributed to that. So she didn't have that, the ESA. And
Hmm.
now she has no money. She's 70. She just retired. She doesn't have anything except Social Security.
Yeah, I mean, I would say the thing is they just don't teach this enough in schools. I mean, when you talk about financial literacy, taxes, credit, I mean, that should really be taught as early as high school, and they just don't teach it. I mean,
Now,
everything that I've taught here today, I did not learn in school. I mean, I did an MBA program. I didn't learn any of this in school. I had to learn about it by chance by being
sure.
recruited by self-directed IRA company and learning. Wow, I didn't even know any of this existed or was possible because nobody talks about this. And of course, you've got the big companies like Fidelity and Charles Schwab that'll talk everybody out of it because they think it's risky. So it's only risky if you don't know what you're doing. So if you're an investor like me, if somebody that's in real estate or lending, this is less risky to me than investing in the markets. I mean, my Charles Schwab account is getting prompt right now compared to what I'm getting in my self-directed IRA notes that are getting interest income every single month.
Yeah, we just had a gal, a friend of mine, who has a 10-year-old daughter. They've been talking to her since she was 3 years old. They also hire her, so she has her own Roth account and her own insurance account, of
Yeah,
which, she can use the insurance to invest, and she's using the Roth to invest. She invests with her mother and father when they invest. So always as because she can't she doesn't make that much money a year, and she's only 10 now. And then she also contributes uh, to donating. So they travel in many places, and everywhere they travel, they always look at how much does something cost. And then charity wise, they look at, would $20 in some countries, $20 is like $100 here.
oh yeah,
And
yeah,
so that education, by teaching your children at a very young age, this young lady is now talking to all of her friends about money. They go
yeah,
shopping together and they actually look at if they could get a better deal online than they can at the store. And they do all
yeah,
kinds of comparison shopping. And they're 10 years old,
yeah,
right? So
yeah.
having parents that start talking to you when you're 3 just makes a huge, huge, huge difference. And having the smarts about the financial smarts about
Oh yeah,
using hiring your child and
oh
paying
yeah.
the child so that they could have a Roth account, right? So if you
Well,
start a Roth account at 3, by the
yeah,
time
yeah.
you
If you
retire,
listen to we've got we've got a directed IRA podcast. We also do a Main Street Business podcast. That's with Matt Sorensen, our CEO, and
yeah,
Mark J. Kohler, who's our CFO, who are both nationally renowned in their own rights. But they do a Main Street Business podcast, and they're always talking about the strategies of setting up like your corporate veil, your companies, your ways to pay your kids, ways to set up your asset protection. I mean, we do a lot of education that is not specifically geared to just self-directed IRAs, but self-directed IRAs are obviously a component in that. But yeah, I mean, you're right. Getting the kids started early, if you're a small business owner, getting them on payroll, the massive tax advantages of paying your kids. I mean, it's ridiculous. Why would you not pay your kids? If they have the ability to work, you should be paying your kids. It's a tax deduction for you. It's tax free to them. And it gives them money, earned income, so you can make contributions to their Roth IRAs at an early age.
exactly. That's so smart. And yeah, I don't know why people don't do that.
They just don't
Yeah,
know. They don't know what they don't know.
Can I ask a question, really, like two questions? I couldn't figure out how to do the raise my hand on here. It wasn't working. So I'm
oh,
just breaking in. Can I ask a couple questions specific? Hey, on crypto, how do you guys handle crypto in the self-directed in
So
your
we Yeah, so we have a special relationship with Gemini. So when somebody opens up a crypto IRA, they can open up crypto Roth, crypto HSA, crypto ESAs. It's a separate IRA because we as soon as you open that account, you have a trading account through Gemini.
Okay.
The reason why we use Gemini, they're one of the most highly regulated platforms on the planet. There's a lot of other places we could have gone, but thank God we didn't. But basically, it's a closed loop system where you can conduct the trades, but the account is owned by your IRA. And all the money has to flow back to the IRA. If you sell anything and want to take a distribution, it has to go from Gemini back to your IRA. So again, what are the benefits of an HSA? Think if you had an HSA invested in Bitcoin a few years back or something like
Right.
that. The gains are ridiculous. And again, coulda, woulda, shoulda, but it's, if you have that type of investment go to the moon, there's no taxes. There's also no reporting. One of the things with crypto investors that I hear is just the painfulness about the reporting. If they're buying and selling, they got to report all the trades. Your IRA doesn't have a tax return. Your Roth, your HSA, your traditional, your ESAs, they don't file a tax return, so you don't even have to report the trades, and all the gains are completely tax free. But that's how we handle that. We handle that through Gemini
Yeah,
specifically.
thanks. Okay.
Okay.
And then question two, like, do you have a listing of I don't know how you guys work it, but are there people looking for deal flow like with their IRAs that you guys have procured a list of people that
I wish. Yeah, we we
yeah,
we
okay.
we can't do it. We're not allowed to put people with money with people with deals, but I will say we do it through events. So we do 2 live events, and I invite anybody to attend. If you want discounted tickets, just shoot me an email. We do our self-directed IRA summit every year. It's about 300 people. It's a 1-day crash course on self-direction, but it's also a great networking opportunity. We're doing that in Austin, Texas next month, April 25th, 26th. And then we do our larger event in Scottsdale in October, which is our Alternative Asset Summit. It's a 2.5-day event, 12, 15 different speakers, all just education, no pitching, no deal pitching, anything like that. But it's about 400 to 450 investors. Most of them are our clients. And what they do is they come because they want to meet and rub elbows with investment sponsors to figure out where they want to deploy their funds. So I would say it's well worth a couple $100 for a ticket. Most people, we get more VIP ticket purchasers than anything because they want to have access to the special, functions with just the VIPs, but tons of money in the room. That's how we can put people together. They'll put on an event and invite people, and then they can work out deals amongst
Where
each other.
where is that?
We do this self-directed IRA summit in Austin, Texas, this April 25th, 26th.
Yeah, I
The
got
website's SDIRAsummit.com. And then our alt asset summit is in Scottsdale, October 17th, I believe. We're still working out the details, but it'll be mid-October in Scottsdale. And that's altassetsummit.com.
all assets. Are you doing any of the live? You used to Quest anyway.
Yep.
Did the live monthly, twice a month actually.
Yep. Twice a month we do our directed IRA webinars. So you can
Are
find
you
that
still
all.
doing that?
Yep. You can find it all on our website. Yep, I've got a webinar next week with Ron LeGrand, my buddy Ron LeGrand. So, yeah, so we've got a learn tab there and a lot of education there. So,
Yeah, but you don't know the live events were where we all came on and talked to each other. Your customers.
those. No, we don't do those. I know what you're talking about. You're talking about, I know specifically who started that. That was Haley Gant. It was more like the wine and like networking thing where everybody just kind of like gets together and just chats. Yeah,
Well, it
we're
was
not
on a
doing.
Zoom. It was Zoom.
No, I know, but they did it like they pitched it as like grab a glass of wine at some point and like network online or something like that. We don't do that where it's like open community networking, but you can jump on any of our webinars and the chat function is all people just networking with one another. So we save the Q&A function for questions for the presenters, but all the chat function is people saying, hey, I'm Joe in Indiana. I've got money in my IRA. If anybody's looking to do deals in Indiana, let me know. Or if like somebody has a deal, hey, I'm so and so in Detroit. Like I'm doing deals out here. Let me know if anybody's looking to deploy some funds out there. So yes, that community there is open to anybody that wants to
Okay,
chat.
I'll look into that. So do you have so you have people come on and you interview them like a podcast. Do you have people that are not investing because they don't know how to do their due diligence? Because we have a
Uh,
mastermind that teaches people how to do their due diligence so that they can be
uh,
intelligent about investing.
yeah. Well, yeah, I mean, if yeah, send me information on that. I'd love to look at that, and maybe we can highlight that as something we can highlight and give out to people. As far as like if you're interested in learning more about due diligence, Peggy's got this event that you can register for or attend, so we can definitely, try to funnel people from our program to yours if that's something that as long as
Yes.
it's education based, we don't mind putting it on there.
It's an 8 weeks mastermind. Angel, you
Okay.
have any questions?
Angel, you're so quiet over there.
I put mine in the chat. I was confused between the HSA and the FSA.
Oh, did I answer that or did I need to go
You
back over
did. You
that?
answered it. I was thinking that the HSA was the one that if you don't use it, you lose it.
Yeah,
But it's the
it's because
FSA.
they
You're
need to
correct.
switch names. They try to trick us with the names and call the flexible one the one you always lose all the money. So it's like,
Yeah. Well, we had a PPO with an HSA.
mhm,
But I have a son with pretty profound special needs. So like
mhm,
right now we're paying 78,000 a year out of our own pocket for his ABA.
mm,
Um,
okay,
and so I don't even know how an HSA could keep up with that. Like we're looking at setting up a C corp and
okay,
potentially running all of the employee benefits through the C corp so that we
okay,
don't get taxed that way.
okay. Yeah, I mean, there's probably a lot of different angles you can try to, help that with. How old is he or she?
He's 14.
14. Okay. Do you do real estate deals by chance? Like, I mean,
I
or
do.
I don't.
No, we
Okay.
do.
I mean, you could try the HSA, or not, sorry, not the HSA, but the ESA does allow you to pay for special needs and even homeschooling with tax-free dollars. I will just tell you, I'll just throw a deal out that my buddy Alan did years back, where he's got a kid that he was just trying to get through private school, and private school is just expensive. He
Mhm.
just located a deal that he found under market value that he knew he could just wholesale or sign the contract for a decent profit. So the whole purpose of the deal, though, was to pay for education. He knew that if he did the deal, if he signed the contract as Alan the real estate investor, Alan the real estate investor pays 40% in taxes. So he didn't want to lose this large amount of this assignment fee to taxes. So what he did is he just set up an ESA for his daughter. You could set up an ESA for your son. He put in $500. That was it. Like he just needed $500 to deploy for the earnest money deposit. He negotiated the terms with the seller. The buyer on the contract was his daughter's education savings account. Okay. The contribution that he made to the education savings account was what we wired to the title company for the earnest money deposit. 8 weeks later, he found an end buyer that would close on the property and negotiate a $40,000 wholesale fee or assignment fee that came back to the ESA, which was tax free to pay for education. So if you think along those terms, if you've got a screaming deal, I would set up an ESA for that child before they turn 18 because 18 is their 18th birthday is the last time you can make a contribution. But if you can find a deal like that, I mean, that's the best way to have some money come in that's not taxable that can go right back to pay for a lot of those
Right, and
expenses.
then you could just keep investing that, even if you can't make another contribution,
Yep.
you
You
grow
could just,
through that.
yep, you could
So
just
does it
keep on
make a
investing.
difference? So we'll have guardianship of him for the rest of
Mhm,
his life.
mhm.
So does that make a difference? Like because in Texas they go to school until the 22nd birthday. So is there an
Yeah.
age
Well,
allowance
there,
because of the guardianship?
by tax law, the ESA stops at age 30. So you can invest the account and continue to grow it all the way until that child is 30 and still
Okay.
take tax-free distributions to pay for all of their needs.
Okay.
Just a thought. I mean, you probably want to have, several different accounts. I mean, the HSA might pay for some of them, the ESA might pay for some other expenses, right? But it's that tax-free vehicle. And if you could just start identifying deals that fit better in that vehicle versus personally,
Hmm.
then I would start identifying some deals to put in the name of the ESAs or the HSAs because you
Hmm.
can use the money right away, which is the benefit to those accounts. Is as soon as they make money, you could take the money out tax free to pay for those needs. So, but again, there is a timeline on setting that up before their 18th birthday. So you may want to just contact us and set one up, this year if you want. Just throw in a couple $100 or whatever you think you need to cover an earnest money deposit and maybe see if you can do something creative like that.
Huh. Yeah, no, because right now we just pay it straight. But if it was in some kind of an account that was growing, that would be more ideal.
Yeah.
Yeah. You can consume more expenses when the money's not taxed. So you'll find like, oh, let's just keep investing this bucket because we can pay for the same expenses, but we're not taxed on this bucket. Whereas it's harder when you're paying it with your own money because it just feels like you're spinning your wheels, paying
Yeah, to the
taxes,
tune of
paying expenses.
1,500 a week.
Right,
Yeah,
right.
and you still can deduct, if you're not gonna have enough money in all those accounts, you still are gonna be paying out of your pocket and that'll still be a deduction on your taxes, medical.
Well, we should still get to deduct the premiums and any copays.
Yeah, you do.
But our copay is $1,250, like $1,250 for the whole year. We have the super duper platinum plan.
Yeah. So you might not want to mess with the insurance, but the ESA, I would
Mhm.
say there's nothing really stopping you from setting up an ESA, putting some money in there. Try to find some creative deal. Even make it a crypto ESA. I mean, if you don't have an investment, open a crypto ESA.
See, I don't know
Crypto.
anything about crypto and I don't invest in things I don't understand.
Well, I'm just throwing things out there. It's just like the vehicle doesn't pay taxes. Whatever
Mhm.
you think you can grow it in, open that account and have that account invest in what you think you can, where you think you can grow it. But remember, that account does not pay taxes. So you'll be able to use more profit without Uncle Sam touching it to pay for the same expenses you're paying for now.
And I love that idea. Thank you.
Jamila, you have any questions? Sometimes you do. And we are at the top of the hour, so thank you very, very, very much for being here, Nate. I really appreciate it. It's been very enlightening. We're so glad that you talked about what you talked about and really educated us on different aspects of how to use IRAs. And I loved your examples, and I'm sure you've got a few more examples you could share with us at some time in the future.
Yeah. Well, thank you guys. I appreciate you having me, Peggy. And just again, shoot me an email if you guys need anything at all. I'm here for you guys.
Okay, thank you.
Okay, no problem. Have a
Thanks,
good one.
Nate. Yeah.